first crowdsourced asset managers. So with us, you can both trade your own account, and also you can invest into other traders and share profits with them as you do so. Because I've had a fair amount of years in the industry, I know quite a bit about how brokers are organized internally. So I'd be happy to try and answer any questions you might have. And one that crops up a lot with people, it's the old market making dealing desk versus STP, DMA, a lot of alphabet soup questions, basically revolving around when I trade my trade, what happens after that? Am I trading against the broker, or is it really reaching the open market? And when I go along the euro dollar, what the heck happens in the background? And I realize there's a lot of people who spend a ton of time trading but don't really know a lot about what's going on behind. So thus the reason for this webinar, and I really do hope that you post as many questions as you might have, because it's always good for me to learn what gaps there are and how we can help address those. So with that brief intro, let's get going with it. So and I'll take a bit of history before we dive right into it, because you need to understand a bit of the background on how the currency market worked historically. It's an OTC, that means over-the-counter market, meaning unlike shares or futures, which are traded on an organized exchange, which has its own set of rules, the currency market was always traded bilaterally, with everyone bidding against everyone, and we'll see what that means for you when you're trading, say, currencies or CFDs, contracts for differences, with a retail broker, because there are some things you should know. We will be talking about the MetaTrader 4 platform, which is proven to be one of the biggest platforms for contracts for differences, and there are a few things about that platform that you should know about too. And last but not least, I'd like to introduce some terminology, which it might sound a bit pedantic, but a lot of people talk about brokers, like retail brokers, but in reality 99% of so-called retail brokers aren't brokers at all. They're actually either dealers or broker-dealers, and that does make a difference, because the incentives of a broker and a dealer can be quite different. So let's get going. As I said, I can see a questions box here, Simon. I don't know if the questions will pop into me right over, or you'll be able to just feed those to me, but either way I'll be watching. Something happened on my... Okay, I saw a ton of them, and now I think I'm at the bottom. So any questions you guys type in, I'll try and I'll basically have a look at it and try to answer there and then, or perhaps just defer for later down the presentation. Okay. So with the background, I mean, if you think of the counter currency market before 1995, before the internet went really widespread, so essentially what you had was central banks and governments on the right-hand side, and they're the guys who basically own the asset. They're the only one who print new money. In the middle, you have major banks, or major investment banks, the likes of Goldman Sachs, UBS, and so on and so forth, and other commercial banks who all, as part of their normal business, receive the money wired to them by customers. They have to wire that to other customers, and so on and so forth. And that led to the rise of a network of bilateral relationships. When I say bilateral, I mean Goldman Sachs has a relationship with UBS. UBS has another relationship with Credit Suisse, who in turn is also connected to both Goldman Sachs and UBS. But there's no central exchange which acts as the counterparty to everyone else, but rather you have a big spider web where those banks are talking to each other. And then, of course, there was you with your £1,000 or what have you, which is like a way too small amount for you to be able to tap into that network. So meaning, as a normal average person in 1995, there was just no way you could ever trade the real market. It wasn't even, it was unthinkable at the time. And believe me, I was a student in those years. Now, at some point, what happens is that technology becomes more and more widespread, and what happens is that suddenly there are independent traders who have a way to tap into the interbank market where the over-the-counter currency exchange traditionally takes place, and all of a sudden there's people who start trading, there's people who start giving webinars, and then there's you, of course, who's now listening to this. So it's a big evolution in this whole game. And now you really, I mean, this point is about telling you what are the ways that you can plug into the market. And there are essentially three types of intermediaries that you can use. And those are dealers, broker-dealers, and brokers. And the core point of today's presentation is to explain the difference between a dealer, which is a market maker, or a dealing desk, that's where the word comes from, which has a pretty bad press, and what a broker or an STP or a DMA provider means. And they are, as I said, you can go long the euro dollar with both in reasonably similar conditions, but what happens behind the curtain is quite different between both. And I'll try to explain to you how what goes on there. Okay. So we'll start with a dealer. So the first, the left-hand side, we're going to tackle this one. Basically, this is how a market maker works. So if you want to go long the euro dollar, you go long the euro dollar at the bid, and the dealing desk goes short the euro dollar at the ask. But really, the only thing that's flowing between you and the market is some price information on what the right price should be at which that exchange takes place. The trade itself is really a two-sided bet where basically your win is the dealer's loss and your loss is the dealer's win. It's really, I mean, it's a very educated way of saying a casino, really, where there's a market price feed that is informing the rules of that game. So it's ideally the dealer should not be able to make up the price and should be able to prove to you that whatever trades you have, whatever bets you have placed against him have been done at a fair market price, which should be able to, you should be able to gather from independent third parties. Now, importantly, this trade never really reaches the market, and it's just an over-the-counter agreement between you and the dealing desk. Okay, and this has some implications. Now, how does the dealer make money? Well, as we just mentioned, the dealer has a trading P&L because at any given time they are buying off you something at a certain price, and then they're trying to resell that something, say the one lot of euro dollar, to the next customer as quickly as possible, and in the process they pocket the spread with minimal risk. Okay, so what's going on is like you go along the euro, let's say you guys are a dealer, so I go long against you guys, and then you have some risk in your balance sheet because you're short the euro dollar until somebody else comes and takes my opposite position and basically cleans up the risk in your balance sheet, and basically you're pocketing the spread on the way on both transactions. In addition to the bid-ask spread, if customers hold on to a trade overnight, then they pay financing charges, and basically that's net revenue for the dealer. Now, of course, there's a cost to this, and that is the dealer has to take risk. You're basically acting as a casino. You have the obligation of taking the other side of every customer's trade, and what you don't want is that it's two things really. One is that too many customers pile in to your books on the same side. So if everybody goes short the euro dollar at the same time, then you land a huge long position in the euro dollar, and that is a risk because, of course, if the market were to move against you, that could take you down. It could cost you your capital because way too many customers have made a way too big P&L, and you can't really make good on your bet. And basically for you to be able to stomach that, you need some capital, which is of course expensive. So you have to make sure that you have a huge pot of cash that's sitting around, because customers could always claim their P&L at any point in time, and if you don't have it, then you could be bust, and that's the end of your business. So What does that mean? Well, this of course gives rise to a set of incentives. So what dealers like is what I call granular customer P&L. So you have a lot of typically, ideally, very small customers as compared to your own size, who are trading a lot very frequently, and who are ideally trading randomly on both sides of the spread. So they're like going long and short the euro dollar at short intervals of time, because that basically means you're getting to keep the spread without really taking any risk in one direction or the other. And then, of course, you also like long-term trades because the risk is a lot easier to manage there, and that brings you as well some financing charges. Now, why did I say the granular bit? Well, because if all the customers are similarly small and they're doing random things, that means that no individual customer has enough muscle to break you, who are really the house. And because of that, if they're very random and they don't tend to go at the same time in one direction or the other direction, that basically means you need very little capital, very little shareholder muscle to pocket a lot of spread, and that's basically when you really like it. Okay. And I guess that the best way you can think of this model is really a fishbowl, where traders are the little fishes here. They're kind of all swimming around each other. They're never really reaching the real ocean, which is the interbank market, because basically all you're doing is placing two-sided bets against each of them and waiting that the next guy basically frees you up and gives you the spread without you incurring extra risk. In other words, unlike what most people think, the market makers here is not so much the dealer; it's actually every little fish for the fish next door. So basically one guy goes long the euro dollar, the dealer takes the opposite side for a couple of seconds until the next guy goes short the euro dollar. The dealer is ultra happy because he got to keep the spread and he's not taking any risk whatsoever. Okay, so it's pretty much free money if you think about it. So far, any questions? Okay, looks like we're good. So let's keep going then. Now, of course, there's one thing which dealers do not like, and that is customers who win. Because what happens if a customer keeps winning and winning and winning? Well, it's two things. One, he becomes big enough to be able to threaten the house. So basically, it could become more of a one against the other bet, and in that situation, the odds are not so stacked in favor of the dealer. And the other thing is, of course, that if a customer is winning, then that basically is eating into the dealer's revenues long term. So if you know, it's a zero-sum game. So if there's one customer who's making a ton of money, that's because it's eating into the profits of all other customers, but also into the dealer's profits, and that can be an issue. And it can also be a situation which can be easily manipulated, in the sense that the dealer who's making the market is also basically who's one side to the bet, has the potential of actually quoting the price at which the bet is settled, meaning you can essentially be the referee. You can play the game and be the referee at the same time, and that materializes into nasty stuff like deliberate slippage, which you can't really explain through market movements, requotes, when the dealer essentially refuses, basically tells you he's willing to trade at a certain price, and then you hit the button to trade, but then the dealer refuses to fill you at that price. And then the other pretty bad one is, of course, stop hunting. So basically the dealer knows you have set your price at a certain level, artificially pushes the price down to that level, your stop is triggered, you've locked in your loss, and then magically the price feed goes in your favor, but by the point you're already out of the trade, which means you've kind of been scammed out of your trade. And why could this all happen? Well, really because the interest of the owner of the dealer or the dealer themselves are actually I've written broker here, even though I should have written a dealer, so I'm just going to change that straight away, because this is not a broker, it's a dealer. Apologies for that. That's because the incentives are not aligned. It's a zero-sum game. It's a bet where one guy is trading against the other, and and this creates this conflict of interests. So Mike is mentioning there are plenty of brokers who offer no dealing desk service. They just charge a commission in and out. Exactly. That's what a broker should do. That's what a broker actually is. If they offer a service other than commission in and out, they're not a broker. They're a broker dealer or a dealer. But yes, I agree with you, Mike. So the second bit is, of course, counterparty risk. What you don't want to have is a trader who's way too successful beating the dealer that you're trying to beat as well, because if that guy makes too much money, kind of fighting the so-called broker, which is really a dealer, what could happen is that the dealer goes bust, and in the process, some money gets lost, which was your money as well. So basically, you don't want to lose against your broker, but then you don't want somebody else to win too badly against your dealer, because then you could end up losing yourself, and that's kind of a problem too, which could result in counterparty risk. Because of all this, dealers, like pure dealers, got a pretty bad reputation, and as Mike is hinting, the people started demanding a fairer environment, where essentially they knew that the trades were really being placed in the open market, or at least some of the time, and that this gives rise to the A and B book broker-dealer. So people who could be either a casino on the one hand, but also a broker, which is basically charging you a commission in and out. How does it work in this situation? Well, as a trader, you go long the euro-dollar, and then the broker makes a choice. They can either B-book you, as it's called, which is basically to take the other side of your trade by going short the euro-dollar, or they could A-book you as well by, in addition to going short the euro-dollar against you, going long the euro-dollar against the market, so that they don't have a conflict of interest. The only thing that's going on is essentially they're acting as a middleman between you and the market. They're charging you a commission for that service, but they do not have a conflict of interest. Rather the contrary, they want you to win long-term, because the more you win, the more volume you'll do long-term, and the more commissions they'll get off the back of you. So the conflict of interest, provided they act as a broker, is gone. Okay. Now, the interesting bit about this, for those of you interested in more sophisticated optimization and statistical analysis, is that you can manage the B-book at two levels. You can either basically try and say that, you good traders you send to the market directly, because that way you're not going to get caught on the wrong side of a trade. Or what you can do is manage the risk of your client book on a portfolio level, so that you try to maximize the spread revenue you're making by customers trading with you and against each other, against the trade-off of having too much build up in risk on your books. Those are essentially the two ways to manage the model. The revenues are quite similar to the dealer model. So on the one hand, you have trading P&L. You're keeping the bid-ask spread by providing the liquidity. Of course, you're charging for swaps, and your costs are the same as the dealer. You also have to have capital for those that in those instances where you're keeping the risk in-house. But you also have an additional risk, and that is when you're acting as a pure broker, you also have to pay a cost. Just like you've charged a commission to your customers for getting the liquidity, you have to pay a commission to your prime broker for getting the liquidity. And what you do is a margin markup. So you basically charge the customer a retail commission, and you pay in the interbank market a wholesale commission, and the difference between both is your commission profit. So the ideal broker-dealer business model is the same as with a dealer. To you, sending trades to the market is actually a cost. So you want to send as few as you can to the market. So essentially nothing's changed vis-a-vis a dealer, particularly knowing that most retail customers actually lose. So it's not a big deal in this situation. But of course, you have an extra wild card, and that is when you have way too much exposure to the euro-dollar, because all your customers have suddenly decided to go long the euro-dollar. You have a way out, and that is to basically send to trade against the market, long the dollar, to offload some of the risk that you have against the broader market, making sure that way you can be much more capital efficient. So rather than keeping capital to make sure that you can withstand any buildup of risk, what you do is set up rules that specify, okay, whenever I have too much exposure on any given asset, then I have a policy to hedge that exposure against the market, and so I don't blow up if the market were to go against me at the times when I have too much open exposure. Okay, so it's a similar thing, but it's a casino that can go to an even bigger casino, the market, to hedge themselves in case somebody becomes too big for their liking, either an individual customer or a build-up of customers. You can still have, of course, the requote, slippage, and last look as an end customer, but counterparty risk is mitigated because it's unlikely that any individual customer is going to be beating the dealer. Now, there's a catch in all this, and I don't know if you have noticed. Basically, if any of you guys wants to make a proper living out of trading, more likely than not, you will need some investor capital to generate enough revenues. And in that situation, what happens is you're going to, like, if you go to a small dealer with an account of $5 million, then chances are they will not be able to fill your trades out of their own book, and what will happen is they'll basically send you to the market as a broker-dealer, and you could spend quite a bit of time polishing a strategy, and this happens particularly a lot with scalpers. Like scalpers, what scalpers are doing is that they're taking advantage of mismatches in the price feed by the broker that allow them to make a systematic profit by taking advantage of the fact that, say, the price feed does not update as quickly as the market did. So you can essentially buy something off the dealer that's already at a good bargain vis-a-vis the market price that has moved, and then you can go against the broader market to lock in the profit. And that's basically what scalping is. It's playing dealers against each other, which is a nice and, so to say, an easy way to make money in the short run. But the problem is it doesn't scale. There comes a point where the dealers start requoting you, or you have a rejected quotes and so on. And at that point, all the time you have invested into polishing your scalping strategy it hits a wall, because you'll never be able to get bigger than the size you've gotten at that point. So, and this happens quite a bit. Like, there's people who do execution advisors or EAs or algorithms and so on that are highly optimized for those sort of profits. They then try to scale those profits from a 100K account to a couple of million K account, and they realize all of a sudden their magical strategy stops working, and they don't really have a money multiplying machine the way they thought they did, and basically they have to go back to scratch and start over again, or just not grow anymore, which is obviously a bit of a waste of time. So I just wanted to share that the foreign exchange trading and even CFDs no longer needs to be only over the counter. You have the option of going to exchanges light. For instance, there's the LMAX exchange, which is a multilateral trading facility that has a centralized order book where you're trading foreign exchange just the way you trade futures or stocks on a fully regulated, MiFID regulated environment. So what happens there is you go long the euro dollar, the counterparty, the LMAX would act as your counterparty at all times, but they also face all the other counterparties, and all the flow across everyone is centralized in a single order book. So rather than individual bilateral relationships between each market participant, what you have is a hub and spoke model where everybody's trading with a central counterparty, and the central counterparty aggregates the liquidity on behalf of everyone and minimizes the counterparty risk, which is, if you ask me, the proper way of trading on any market, especially a market as plain vanilla and liquid as a spot foreign exchange. So really, down the line, I would like, my personal goal in the long run is that over-the-counter retail trading ceases to exist, and everybody's forced on exchange, which is by far the healthier way to go about these things. And that was pretty much the content of the today's webinar. In that setup, of course, what happens is you have a centralized counterparty, and then you have brokers who essentially charge a commission in and out for people to get in and out of the market, as I was showing here. So their incentives are to get you there as quickly and cheaply as possible, so that they can justify the commission they charge you. And yeah, that's pretty much it. So at this point, I was wondering if there's any questions that anyone wants to go through. Happy to take them now. And otherwise, that's pretty much it. All right. So it sounds like there's not a lot of questions. So it was either too clear or completely confused. Okay. Okay. Oh, yeah, we can. Happy to do.